Okay. Hi, Wally. It's a pleasure meeting you. Our audience would like to know anything you would like to share about your fund. I know that you are based in Toronto, but your fund itself is a US fund. Will you tell us more about your investment profile, the size of the fund, and the deals you're looking for?
Yeah, so just to give you a quick history on EnerTech, we were founded in 1996. We came out of a electric utility called Atlantic Energy. They were our anchor investor at that time. We since then have four funds that we've been investing out of, and our kind of core focus areas have always been around what I would call Industry 4.0, kind of on the industrial commercial side of the meter and customer side of the meter, mobility, and then connected customers. So how do you integrate those energy efficiency technologies into either grid networks or result in the customers saving money within their individual dwelling or their business? So we've been focused on energy technology, broadly speaking, but core areas like mobility are part of that strategy. We've done 72 investments since '96 across that focus area in Canada and the US.
Well, then it sounds like your companies you work with are pretty big. Do you do B2B or sometimes you work with consumers directly? So what are the
Yeah, we
companies you
do.
have?
Yeah, typical size company for us is usually 3 to 5 million in revenue. We look at companies that kind of are capital light, so things that are scalable software wise. Are they ones where you need a limited capital base to generate revenue? So in the clean tech space, it's been very capital intensive primarily, but we've tried to stay into the areas that are more software orientated.
So when you say you work with energy companies, it's not exactly that you're doing all the from green energy to everything else. You are more software centric. So
A lot of what we do is software heavy, but there's still sometimes there are hardware components to it because you need to integrate it into a building. For example, we invested in a company called Distech, which did building automation for commercial buildings around energy efficiency, lighting controls, HVAC controls. That was an opportunity that we saw as a high growth area, and ended up getting bought by a company called Acuity, which is a big public company focused in the lighting area. So things like that where it's scalable, it's a software hardware play, but the hardware piece is a small component of what we do. So
yeah, well, hardware funds are hard to find these days because it's, as you said yourself, it has to be scalable first. And when you deal with the key, yeah, well, yes, it has to be
yeah,
scalable.
we have a long history with strategic partners. So we have a lot of strategic utilities, gas companies, groups like Waste Management that are involved with our funds. So they help some of these companies to accelerate their growth rates more quickly, but through partnerships and licensing opportunities that we try and help facilitate.
I guess we cannot avoid the word sustainability when it comes to working with big utility companies because they have to move into this next generation. Forget their revolution 4.0. They're in their own revolution, right? So do you help them with the new technologies? So I mean, when you say help, when you work with your portfolio companies, they theoretically improve the state of the affairs for those big utility companies. Would it fall under this whole sustainability impact?
Yeah. So the whole sustainability kind of decarbonization theme is a big part of what we look at. And our strategic partners, in particular the utilities, are also looking at how they reduce their carbon footprint, but they're also looking at ways that they can create efficiency within a grid network. For example, can you become more a distributed generation asset where they can use that asset to help them manage the power distribution network more effectively? So what we call distributed energy resource management is an area which we've invested in the past around, how do you take all those solar storage, all the things that are integrated into the grid network, but allow the utility sort of a bi-directional capability to know what is in the network, and can they use that asset as a utility to help them balance their load. So there's a payback to them, and there's a decarbonization impact for them around kind of what they do in their carbon strategy.
Well, it's a very current and important direction. And I guess you started a while ago. You said 96. So by now, when many companies are just saying they love that field, you actually can show not just investment, but also the exits. It's quite impressive. So now,
Yeah, and
are you only?
there's been a real evolution. I was going to say there's been a real evolution in our space over that since '96. We were kind of the early pioneers in energy technology at the time, and now there is a number of funds that do what we do, but we've seen the models that work and the ones that don't over that 20 plus years of doing this. So.
Yeah, you got a head start. So I guess you made your mistakes earlier. Now when you watch these newcomers, you go, yeah, and you will have to deal with this and that. Now, are you like totally US centric, or you invest in companies not exactly that they were born in the US, but say if the idea came from outside the US and the founders came from the outside of the US, but then they became US companies, do you invest in the
Yeah, it's
companies?
really Canada, US. We say North America, but it's really Canada and US. Now the technology may have come from Europe or somewhere else, but they're domiciled in North America. As you know, in venture capital, you want to make sure your companies are relatively accessible, and if you got to fly 7 or 8 hours to get there when there's an issue, it makes it a lot more difficult. So we like to stay within the North American platform, and with COVID, it's makes it even more important that you can get access to these companies, in a different way than you did before. So.
Yeah, how do you do that now under the new circumstances? I understand, like in my own portfolio company, if I knew these people before, it's not a big deal having a conversation like that. But when you make a new investment, you actually have never met them in person, because it looks like we've been on this lockdown forever, at least in California, like 9 months almost.
Yeah.
How do you do your due diligence now? How do you make that investment decision if you don't have a luxury of visiting the company like right where they are?
Yeah, I would say the thing that we do now is we need to make sure there's a co-investor that knows the management team even better than we do, because going into a investment where the management team is completely unknown and doing it through calls like this and Zoom is not necessarily the way you can get all the information you need to make a decision, because as you do due diligence and you're on site, you sometimes learn things from people that aren't part of the senior management team, even, that you decide, okay, we need to check into that. But I think that's sort of how we view it, is it needs to be a group that knows this management team if we're going to go into a deal during this COVID timeframe. So I think pre-qualifying that team from someone who's already been close to them is important.
That's when the network becomes so important. And the funds, it's not that hard to start a fund, but to have a fund that has its own ecosystem, which plays with other funds' ecosystems, that's what you can rely on the due diligence, on references, and like in your field, what if you were to describe the elements of the ecosystem around your fund? So it will be obviously big players like utilities and energy companies. Now, do you work with the universities? Do you work with some academic centers, or like who will be the main players of your domain around your fund?
Yeah, so one of the groups, since you're in California, you would likely know a little bit about is the California Mobility Center that's just been formed in Sacramento with SMUD.
Yes.
And SMUD is the utility in Sacramento. They're one of our strategics, and we are one of the sort of founding members of that California Mobility Center. So they're going to start to commercialize earlier stage mobility and transportation technologies that could integrate into the grid network. And we'll see a lot of those things much earlier in the process to get a sense of deals that we could invest in down the road. So the California Mobility Center is one example. In Canada, we've got a lot of university connections and a lot of the key strategic groups in the Canadian market that see deal flow. Same with many of the US universities and the accelerators, and we stay very close to those groups because these companies kind of evolve into investable companies as they go through commercialization processes.
Mm-hmm. Well, we in our audience also have some, I call them aspiring investors. That is people who have made money in different industries and now they want to invest in high tech. And sometimes, well, especially when they come from Europe or Asia, their idea of investing in a company is when they have to actually be an active manager of that company. And we keep telling them, no, once you invested in the company, you are an LP, and there's a difference between LP and a GP. So what will your advice be to people who want to say they have 2, 3, 5 million, and they want to be a player in this high-tech field? Should they, in your experience, just find a company they like and give them money, or should they invest in venture funds? Like, what would be your recommendation?
Yeah, I mean, they need to obviously, with their money manager, look at their asset base and figure out what the exposure to, venture capital is a risky asset class, so they got to be prepared to take risk. What I would say is a lot of high net worth investors sometimes go directly into companies that they see they can add value to, and a number of those have worked out well. And then there's others that they go into companies that may not be best in class, but they're the first company that they've seen. They throw their money at it and realize that it wasn't what they thought it was. And then they've got all their eggs in one basket. So I think they just need to think about diversification too. So you're not, putting all of your investment dollars in private, capital into one asset. So they can spread it around a bit. It gives them a little more flexibility too. If one doesn't work out, they've got, the balance in the portfolio. So but they really need to look at, as a percentage of their total assets, what percentage is venture capital, and it shouldn't be a big percentage because most of their other assets are probably invested in more liquid type investments. But it's really their money manager should lay out for them the allocation that they may want to have to that area.
Mm-hmm. Yep, I agree. So there's a flurry of exits, and I know this format, that's SPAC, that's Special Purpose Acquisition Corporation. That format has been around forever, I think from the 80s. All of a sudden, all these companies want to do the exit via that format. Do you have an opinion? Is it a good thing? Is it a thing?
Yeah, I mean, it's been tricky because there's been a lot of sort of SPACs that have been completed, and then ones that they haven't flamed out, but they've had difficulty kind of on the delivery side of it, meaning that they gave you all kinds of projections and maybe the things didn't quite match up to the projections, because they are like venture companies going into a public vehicle. So people got to recognize that they're putting up projections when they do the SPAC that are just like a venture capitalist looking at a company. They're probably not always going to hit those numbers right away, but the stocks can be very volatile because of it. So I would say it's a way to get public. It's just the people that do the SPACs need to make sure they're companies with real revenue prospects that can get that revenue quickly moved ahead. Otherwise, I think some of them will not do very well in the market, right? And you're starting to see some cracks in it. I think it's definitely a vehicle to get something public. You just need to make sure whatever the transaction is that you can get that revenue traction in a fairly timely manner, or the stock may not perform as expected post, right?
Mm-hmm. Well, will you tell our audience a little bit about yourself? How did you get into this whole VC field? And have you been an entrepreneur that switched, or are you an investment banker? Or tell us a little bit about how you got into this level.
Yeah, so I started my career started at RBC, Royal Bank of Canada. I was in the capital markets side to start with, and then I went over to run their venture capital fund, focused actually at the time in the late kind of 90s on energy technology. And that's where I sort of got into this space, and then eventually left RBC, joined up with Scott Ungerer, my partner at EnerTech, and been there since. So it kind of started in the finance area, investment banking, venture capital, and into my own fund.
Oh. And the final question, how do people, be it entrepreneurs or those aspiring investors, find you or your fund? What is the best way to contact you?
It's usually not through just an email through the website. It's usually through a contact that knows us, or going directly to one of us. We find the ones that come through as just internet emails where someone's saying, I've got a business plan. It gets buried, or it gets in the deal pipeline. If you want to get to the top of the pile, if you know someone that knows one of the partners at my firm, it's easier to kind of use them to help get it to the top of the pile. Because we see 400 to 500 deals a year, so it's really important that if you want your deal to stand out, you got to try and get it to the top of the pile. There's just the number of emails I get a day is hard necessarily to respond in some cases as quickly. So
exactly, I always ask that question, and because I have a similar situation when you get hundreds of emails and all that. And so like, well, you need to find a way to be different. You need to do your own due diligence and to see if your company actually is a fit for the person, and find someone they trust. And so you are just saying the same thing, but still people want to know, okay, well, we know how to find you. We won't tell anyone unless it's a company, unless it's a company that is a totally direct fit. And vice versa, if you want to look for some potential deals, if you at some point want to see companies that want to do something in Europe or wider United States, well, you know how to find us. So thank you so much for your time. It's been a pleasure.
Okay.
And yes, well, maybe next time when you are in San Francisco, we'll have coffee. Thank you, Wally.
Yep. Sounds good. Okay, thanks. See you. Bye.
Bye.